Good day everyone, my name is Marcus,
And I'm Jimmy.
and if you're new to the channel, welcome. If you're not, thank you so much for supporting us all this while. Just remember that every like and subscription goes a long way in supporting our production. In today's video, we'll be talking about a cryptocurrency that is on everyone's minds, Bitcoin. The Federal Reserve is vastly expanding the monetary base. Like gold and other precious metals, Bitcoin and other digital assets should benefit from an exploding money supply. Even one of America's biggest banks, Goldman Sachs, is holding a conference on the crisis, Bitcoin, and inflation. And it's not just Bitcoin. Many other top cryptocurrencies such as Ethereum, which is founded by some Russian genius, is set to outperform. And here's what I think the best coins are and why Bitcoin is likely to go a lot higher. Now this video will be the first part in a two-part series, and we'll be discussing and going in depth about how Bitcoin works and how to trade it, and the second video, which will be out next week, discussing the future prospects for the aforementioned cryptocurrencies.
First, we need to break down what exactly Bitcoin is and how do cryptocurrencies work in general. Bitcoin was a trend of digital money that became popular around 5 to 10 years ago. So, unless you are still the kind of person that likes to store tons and tons of coins, I'm pretty sure you have heard about it. So, what makes it so different from all the other transactions we do on daily cards and paper bills? Well, normal electronic transactions involved money under a central payment process which is usually regulated by a bank or some monetary authority. But Bitcoins are controlled by a larger distributed network of computers running high-powered software. So, whenever a Bitcoin transaction occurs, these special computers record the addresses of the person who sent the Bitcoin and the person who receives the Bitcoin and saves this info into a ledger within a blockchain. Basically, think of a blockchain as a record book that stores every action, like those old yellow phone books. The blockchain is then verified across multiple systems that process Bitcoin to ensure that the information that is received is all on par. This may seem like it's very vulnerable to hacking and phishing, but because the network is so distributed and encrypted, it will take a lot of supercomputer power for someone to just randomly break into this blockchain. Now, the important part comes in the verification process, which is performed by miners, a term which many of you have constantly heard. So, why do they call it mining? The term mining is not used in the literal sense, but used in a reference to the way precious metals are gathered. Bitcoin miners solve mathematical problems and confirm the legitimacy of a transaction. They then add the transactions to the end of the block and create chains of these blocks of transactions, forming the blockchain. When a block is filled up with transactions, the miners that process and confirm the transactions within the block are rewarded with Bitcoin. Transactions of greater monetary value require more confirmations to ensure security. The software that is used works by grouping, and the groups are only accepted if the entry into the blockchain is keyed in correctly, which happens to be an extremely time-consuming process. And that's why you do not see normal people trying to mine Bitcoins, because, just like a professional miner, they do not have the necessary tools to dig through the clutter. But why do people even mine Bitcoin in the first place? So, once a block has been created, it is officially added to the blockchain and tada! The miner gets 1 Bitcoin in his digital wallet. So, your computer literally ends up creating money out of thin air for you. But again, this whole process requires an immense amount of processing power. And by immense, I mean a lot, because places which mine Bitcoins are usually filled with tons and tons of supercomputers. Although back in the days, you could simply use high-end graphic cards to get Bitcoins. Nowadays, you need to use specific mining technology such as N-miner, which can cost up to 2.2k USD just for one model. Plus, as more and more Bitcoins get mined into existence, it becomes more and more difficult to mine out the remaining Bitcoins that have not even been created yet. In fact, the system is designed such that by the year 2040, which means there will only be around 21 million Bitcoins in the world. And such complicated technology sucks a lot of electricity from one's home. So, if you do not have high enough capital to start with, mining Bitcoins may just end up killing your bills and leaving you in a much greater debt. But this doesn't explain why there's still so much hype over Bitcoin. Well, it's because more and more people are becoming distrustful of central banks as a regulator of their currency and have more faith in a Bitcoin's redundant blockchain system. Plus, more and more retailers are starting to accept Bitcoin as a form of payment, and coupled with the incognito features it gives, it is quite an attractive avenue for those looking to escape any watchful eyes. Now, Let's get into the real analysis of Bitcoin's investment potential.
So let's fast forward to the real world. As the Bitcoin network came into existence in early January 2009 with Satoshi Nakamoto mining the Genesis block of Bitcoin, also called block number 0, the crypto's short shelf life has made it very difficult for professional analysts out there to convince investors on its long-term potential. Asset managers would have been more comfortable if Bitcoin had existed prior to the great financial crisis of 2008, so they would at least have some background information about how cryptocurrencies would perform under the stress of an equity bear market. But again, we have to remind everyone that past performance of equities is not indicative of future results. And as opposed to gold, Bitcoin prices fell sharply in the last two equity sell-off. We saw how Bitcoin dropped by 42% in the last quarter of 2018 as compared to the S&P 500 which only fell 14% and 9% in the first quarter of the year 2020 while the S&P was down 20%. So, it's a huge roller coaster. We saw recently that Bitcoin successfully went through its third halving this week, with the number of Bitcoin rewarded to miners dropping from 12.5 coins to 6.25 coins. As a reminder, the block reward started in January 2009 at 50 Bitcoins per block, and a halving was set to occur every 210,000 blocks mined. And as the Bitcoin difficulty network has established that blocks are found on average of every 10 minutes, a block halving would theoretically occur every 4 years. And the concave shape of Bitcoin's monetary base has led to a sharp decrease in the cryptocurrency's inflation, leaving many Bitcoin fans thinking that a drop in supply would constantly lead to price appreciation. But even as you would compare Bitcoin to many other alternative assets that carry no fundamental value, such as things like gold, which is usually used as a hedge against inflation, expensive paintings, or exquisite alcohol, such as wine, you would expect cryptocurrencies to co-move strongly with real interest rates. But as opposed to stocks or US Treasury bonds that offer dividends or coupon payments, Bitcoin is a non-interest bearing asset and therefore investors would only benefit from an overall capital appreciation. Therefore, if real interest rates start to rise, a rational investor in this case would prefer to reallocate his wealth in equities or bonds and receive dividends rather than invest in such an asset with no theoretical value. And hence, this goes that rising real rates should drive Bitcoin prices lower. However, our position is that Bitcoin still has strong upside potential in the medium term, as the Fed may start to consider negative interest rates when the economy reopens. Even though Chairman of the Fed, Powell, recently mentioned that policymakers were not considering negative rates for the time being, it is surely a topic that is discussed as traders have been pricing in negative rates for the second quarter of 2021 for the first time in history. And we recently argued in our previous videos that aggressive rate cuts from the Fed were unnecessary in a shutdown economy, and that US policymakers should have left little positive room that they had on the benchmark rate earlier this year, rather than a second stimulus option when the economy reopens. Thus, we see that the probability of negative interest rates for 2021 is clearly not non-negligible, and it could benefit some alternative assets such as Bitcoin only in the medium term. Okay, we have come to the end of the first part of this week's video. We hope this video has enhanced your understanding of the basic structure of Bitcoin and why exactly do investors bother to trade it. Again, we hope this video has enhanced your overall understanding of Bitcoin as well as the basics to how it works. Again, we only believe that it has strong upside potential for the medium term, say the next 3 to 5 years. In the long term, we still believe that it is a highly speculative bubble because there's almost no guarantee of its currency, unlike the fiat money and paper money produced by current central banks. So I'll be flattered if you have one key takeaway from this video which you can share with your other friends. Leave any questions you have in the comments below and I'll try my best to answer all of them thoroughly. Stay tuned for the next video and invest safe.
Ever since the day that you